What are the tax implications of inheriting personal property? Have you ever wondered what happens to your taxes when you inherit personal property? This topic can be a bit tricky, so let's break it down clearly. When you inherit personal property like jewelry, art, or collectibles, the tax implications mainly revolve around how the property is valued and what happens if you decide to sell it later. First, it's important to know that inheriting personal property is generally not considered taxable income by the federal government. This means you do not pay income tax just because you received the property. That's a relief, right? Now, let's talk about something called the stepped-up basis. For tax purposes, when you inherit property, its tax basis is reset to its fair market value at the date of the person's death. This is significant because if you later sell the property, your capital gains tax will be based on the difference between the sale price and this stepped-up basis. This is much better than using the original purchase price paid by the deceased. If you sell the inherited personal property, you might owe capital gains tax on any profit. The gain is calculated by taking the sale price and subtracting the stepped-up basis. The good news is that any gain on inherited property is treated as a long-term capital gain. This is beneficial since long-term capital gains tax rates are usually lower than ordinary income tax rates. But what if you sell the inherited property for less than the stepped-up basis? In that case, you may realize a capital loss. However, losses on personal use property, like personal belongings, are generally not deductible. Losses are usually deductible only if the property is considered investment property, which is less common for personal items. Now, let's touch on estate tax considerations. While inheriting personal property does not trigger income tax, the value of that property is included in the decedent's estate for estate tax purposes. If the total value of the estate exceeds the federal estate tax exemption threshold, estate taxes may need to be paid before the property is distributed to heirs. Additionally, some states have their own inheritance or estate taxes, which can vary widely. From the perspective of estate planning, it is essential to document the fair market value of personal property at the time of death. This helps establish the stepped-up basis and can reduce future tax burdens for beneficiaries. Placing valuable personal property in trusts or using other estate planning tools can help avoid probate and might reduce estate taxes. In summary, inheriting personal property does not trigger immediate income tax. However, the tax basis is stepped up to fair market value at death. If you sell the property for more than this value, capital gains tax may apply. Estate taxes may also be relevant depending on the estate's size and state laws. Proper valuation and planning are key to managing these tax effects effectively.